The start of 2025 saw UK bond yields rise to their highest level since the credit crunch of 2008, causing the media to panic the UK was heading towards another debt crisis, worse than Liz Truss, some papers rather hysterically claimed. Now, since 2003, UK debt has increased sharply, from 30% to just under 100% of GDP. And now, with higher bond yields, the cost of debt interest payments has nearly doubled to over £100 billion a year. The UK is one of the most expensive borrowing costs amongst advanced economies. But you could argue that these short-term issues really pale into insignificance compared to the projections for the next 50 years. The OBR say that government debt is set to increase very sharply because of an ageing population, lower birth rates, and a smaller working age population. All of this is going to place huge stress on UK finances. So does this mean that the UK is heading towards bankruptcy? Or are debt fears exaggerated and misunderstood by most of the media? Well, the media definitely can jump on short-term news and declare a debt crisis. I'm old enough to remember in 2010 when the dominant media narrative was that if we didn't have immediate austerity to deal with high deficits, we'd get surging bond yields and the world would kind of end. Ironically, in 2010, debt was actually quite low, just 55% of GDP. It's now almost double that. So firstly, it's always worth looking at debt in a historical context. Since 1776, UK debt has averaged over 100% of GDP. In fact, it's risen to over 200% on two occasions, after the Napoleonic Wars and after the Second World War in the early 1950s. Now, even with very high levels of debt, the UK didn't default, but was actually able to reduce the debt burden over a few decades. If we place UK debt in an international context, UK debt is high, but is not uniquely high. Japan has debt of 254% of GDP, Italy 148%. But if we do go back to the late 40s, early 50s, some things were actually different. Firstly, some of the debt was the government nationalising industries and gaining assets like the railways. The government also invested in rebuilding the economy, building houses. But more importantly, it was the start of a post-war global economic boom. A young, growing workforce helped the economy expand by over 2% a year. And this rise in incomes and output led to higher tax revenues and falling debt as a share of GDP. At the very least, it shows that borrowing for investment does not have to be a constraint on economic growth. The problem for 2025 is that the situation is really quite different. The UK, like many European countries, has seen 14 years of really very low economic growth, GDP per capita barely increasing at all. And when the economy stagnates, so does tax revenues. But you need to keep increasing spending on things like pensions and healthcare, where demand continues to rise. And the OBR are very pessimistic about future prospects for UK debt. Now, assuming no change in government policy, which is a big assumption, spending commitments will continue to soar because of an ageing population, means more pensions, more healthcare, and at the same time, we're getting lower birth rates. A smaller working age population means less tax revenues. Now, this pessimistic scenario is not set in stone. It should be taken with not a pinch of salt, but it's not an inevitability. If the government changes some policies like, for example, raising the retirement age even further, increasing VAT or cutting benefit spending, it could lead to a very different outcome on debt. However, will any government be able to address some of these unpopular long-term choices? The current government lost a huge amount of support just for means testing winter fuel allowance, which only saves around £1 billion a year, a proverbial drop in the ocean. Something like the triple lock pension guarantee has become very important from a political perspective, but it will be increasingly expensive in the coming years and ensures that pension spending will continue to grow probably faster than tax revenues. Now, this is a very real problem because there's very little political incentive to address very difficult choices like how do you fund social care. Now, a really good question to say is, what do we mean by national debt? Because actually the term is something of a misnomer. It doesn't actually mean the amount the UK owes to the rest of the world. Most of the UK debt is actually held within the UK. UK banks, pension funds, investment trusts and the Bank of England. Now in the UK, around 28% is actually owned by overseas investors, overseas banks, which is actually one of the highest rates amongst advanced economies. And you could argue that this high rate of foreign ownership could make the UK more vulnerable. Overseas investors are more willing to sell up and move if they're worried about sterling or the UK economy. I'm not quite convinced by this because overseas investors have similar information to domestic investors, and I don't think it's like UK citizens are buying UK debt, UK bonds out of a patriotic duty to help the government. Perhaps they did in the world wars, but I don't think that spirit is there today. Now, Mrs. Thatcher famously referred to UK finances to be like a household budget. Never spend more than you receive, and she used this to justify a lot of the spending controls of the early 1980s. It was the same logic behind the austerity of the 2010s. And if you view government finances in this context, then debt definitely is out of control, £2.8 trillion and growing. But is this household analogy actually correct? Because, firstly, unlike a household, the government can finance its own debt. Secondly, within the UK, some of the wealthy members of this household have surplus savings. Think of a rich uncle who has retired, whilst others need help buying a house or going to university. UK government debt often mirrors private sector saving. When the private sector save more, governments can use this saving to fund spending through selling bonds. Now, in recent years, the level of private savings in the UK has actually increased significantly. So when people save more, the government can find it easier to borrow. Higher savings at the moment reflect high levels of private pensions and a lack of confidence to invest and spend. So government debt always has to be seen in relation to private saving. If private savings were falling rapidly and the government was borrowing from overseas, then this would be a trigger that government debt is more vulnerable to default and very serious problems. But this is not happening in the UK, at least at the moment. You could argue that one way to look at government debt is that it's really a way to move money from rich, wealthy people who have surplus savings, the kind of people who buy bonds, to people who have much less money. In recent years, the Bank of England have created money electronically to buy bonds from the government. This reached £900 billion in 2021, or nearly 30% of all UK debt held by the Bank of England. Now, in the past 2 years, the Bank of England have actually been quite aggressively reversing this policy, selling bonds back onto the market. It means that in the coming 12 months, the UK will see 300 billion of gilt sales onto the market. And this Bank of England policy to reverse QE is definitely making it harder for the UK to borrow in 2025, and it could be a factor behind those relatively higher bond yields. Arguably, given the state of the economy, quite weak growth, it might be better to wait, but that's a question for another video, whether the Bank of England is doing a good job. Anyway, you could argue it's a strange definition of debt when the Bank of England, owned by the government, is buying bonds from the government. In effect, the UK government is owing money to itself. Secondly, if the UK ever did experience liquidity problems or a surge in bond yields, the Bank of England could always revert to some form of QE, create money and buy those surplus bonds. Now, this is touching on modern monetary theory. The concept is that with an independent currency, a central bank can always finance government spending directly through creating money. Now, in the UK, QE happened in 2009 and a few occasions in the 2010s. It is one reason why government bond yields were so low in the 2010s, making it cheaper for the last government to borrow. Now, increasing the money supply is great when growth and inflation is low. But you might well ask, doesn't printing money to finance debt inevitably lead to runaway inflation? Well, yes, it certainly can. And we have many historical examples, Weimar Germany in the 1920s, Argentina in recent history. It all shows that printing money to fund debt can create a real crisis of inflation, which is just a different kind of government default. Now, it did actually happen in the UK and US to a limited extent in the late 70s and early 1980s. Inflation was unexpectedly high, higher than bond yields, and so bond owners basically experienced a partial default. They lost value. But without getting too technical, QE is actually technically different to printing money directly. In the 2010s, QE had very little impact on increasing UK inflation, despite the scale of bond buying. Even in 2022, the inflation we experienced was primarily due to COVID supply constraints and rising oil prices, rather than QE. Governments are generally reluctant to use unorthodox monetary policy to fund investment, but if growth and inflation is very low, it can be done. However, increasing the money supply to fund all debt is not quite the magic money tree we might like it to be. Any increase in the money supply to fund government spending is limited by inflation and to a lesser extent the balance of payments. Creating money can deal with liquidity shortages and a shortage of demand, but it doesn't directly affect productive capacity and productivity. Creating money doesn't create actual nurses and workers. So it's not a complete solution to an ageing population and massive increase in demand for pensions. You can't just create money for that. Also, it's not just about an ageing population. Future budgetary pressures mean there's also a need to invest in new technologies like renewable energies, deal with the impact of climate change, more flooding, more extreme weather events. There's also a pressure to increase military spending as a share of GDP. This might not matter if the economy was actually growing, but prospects are really quite poor, and it's hard to see that changing significantly. So it is true that in the past 3 years, bond yields have risen significantly. But it's important not to take the wrong lesson from this, because rising bond yields are not necessarily the harbinger of a bond crisis. Rising bond yields can be just due to higher economic growth. Certainly the recent surge in bond yields in the US was due to higher expectations of growth. Investors want to sell bonds and buy shares where they think they can get a better return. Having said that, I think the high UK bond yields are hardly due to optimism over economic growth. If anything, bond yields in the UK reflect expectations of higher real interest rates, perhaps related to a very cautious Bank of England keeping interest rates high despite very low growth. So in that context, the fall in inflation last month was very welcome, as it makes it much more likely interest rates will be cut in 2025. If you get lower inflation, lower interest rates, and borrowing suddenly becomes cheaper, giving the government more headroom to meet their fiscal targets. So in conclusion, is the UK bankrupt? No, it isn't. The government has a capacity to borrow a lot of money, or it can even create the money directly through a central bank if it wants to. Also, with high levels of private sector saving, it makes it much easier to sell bonds. Now, compared to the 1950s, UK debt is actually much lower. However, that doesn't mean there's not reasonable grounds for concern. The underlying structure of the economy is very different. Growth rates are much lower, and the economy faces a very different demographic. The government faces an unwelcome combination of more old people, less young workers, and that means falling tax revenue, but the need to spend more on social care and healthcare. Yet at the same time, there's very little political bandwidth for deciding how to deal with these long-term changes in the nature of the economy. And on top of that, we live in an era of uncertainty. Shocks like 2009 credit crisis, COVID, the Ukraine war, global warming or whatever, they can easily put an extra 10-20% onto debt levels. So it's not a reason to panic in the short term. The government should always focus on people and the economy and not the bond market. But 2025 could easily bring some unexpected shocks which further make it difficult for the government. This video looks at all the prospects for some kind of financial crash in the coming year. So do check it out and don't forget to subscribe. Nice to be back. See you soon.